Robert, the official jobs data for March you're calling eye-catching, not nearly as strong as it was in February. What do you make of that?
Well, Susan, we saw a very strong report in February, up 326,000, robust by any measure, any time. And so should not be too surprising that we see a correction here in the March data, up just 103,000. And we get a whole basket of labor market indicators, not just the monthly jobs numbers, and that whole basket is looking pretty good. So I take this simply as a correction or a reversion to a mean after a very robust month, and by a variety of other indicators, U.S. labor markets are looking pretty strong.
The unemployment rate stayed at 4.1%, but the rate of decline has eased. Does that concern you at all?
Well, it has to ease at some point, right? Because we're not going to go to zero. There's always some frictional unemployment out there. And, an unemployment rate of 4.1 that may be heading to the 3.9, 3.8, that is very low, and that's indicative of a very robust job market. So, no, it doesn't worry me at all. I think we're in pretty good shape here in terms of labor market, and we have some wages coming up a little bit, and that's very good news for consumer spending, jobs plus wages and working more hours. So that's all good.
And speaking of labor, what did we find out about manufacturing in March?
Well, we did get those very broad-based indicators, the ISM Manufacturing Index and the ISM Non-Manufacturing Index, and together they really capture the broad spectrum of U.S. economic activity. Both of them ticked down, but from very high levels. They're still very close to 60, 59 and change. And those are very good numbers. Anything above 50 in those indexes means that conditions are improving. They're simply not improving quite as fast as they were a month or two ago, but they won't keep that up forever. They're very, very high levels, and they tick down a little bit to still high levels. So those are pretty good numbers.
Robert, I also wanted to ask you about auto sales. It looks like we had some surprising numbers for March as well.
Yeah, that was one of the upside surprises for the week. We had auto sales coming back to a 17.5 million unit rate. This is a head scratcher. I'm going to have to be a two-handed economist here and say, on the one hand, we have very good labor conditions. We have workers getting paid well, so they've got money to spend. On the other hand, auto sales were trailing off last year through the year before the hurricanes hit. And so it looked like we were already on the downside of the cycle before the hurricanes washed out a couple 100,000 cars in Texas and Florida. And then we had a sales spike in September, October, November. It looked like we were coming down off of that spike, and now all of a sudden we get a surge in March. So we'll have to see where this goes. On the one hand, I'm encouraged. Consumers should be in pretty good shape. On the other hand, I still think we're on the downside of the auto sales cycle, so I'm still expecting sales to ease a little bit going forward.
Robert, we saw the trade gap widen slightly in February, and you mentioned in your report that the Winter Olympics did have an impact on that. Can you explain that?
Yes, it was some of the royalty payments impacted the trade and services, and that was a net. It shows up as a net export. So the trade gap is going to be very interesting over the next few quarters. In the fourth quarter, trade gap widened considerably, and that subtracted about a percentage point, a little bit more than a percentage point off of fourth quarter GDP. It looks like it's going to widen again slightly here in the first quarter, subtracting more from GDP. And so it looks like a dampening effect on first quarter GDP. That could turn around quickly, though, in the second and third quarter. So I'm starting to put out a little bit of a caution flag for first quarter GDP growth. I'm thinking maybe on the weak side, but I do expect to get that back later in the year.